What is up? Steve here. I hope you are doing well. Today I'm going to talk about a lot of the chatter that's going on with the Fed and the Fed minutes pertaining to the rate hikes, the expected rate hikes, and also we're going to talk about how that's going to have maybe an effect on the mortgage market, because I know that a lot of people right now, there's a lot of uncertainty as to what's going to happen with mortgages and if they're going to skyrocket. So I'm going to bring you through this article, and also I'm going to show you the Fed chart in terms of the Fed rates associated with where they're at today, as well as the history of them, and how it directly with the chart directly correlating with the 30-year mortgage interest rates as well. Now, when the Fed makes it more expensive for banks to borrow money, they're basically going to pass that along to the consumer. Now, that can be in any kind of adjustable rate mortgages, any kind of adjustable rate loans like credit card debt. It could be more expensive to get a car loan, and ultimately it could be more expensive for getting a mortgage as well. Now, when the Fed increases rates, it doesn't mean that absolutely 100% guaranteed that the mortgage interest rates will rise, because there's other factors that have to be considered by lending institutions in terms of raising or lowering mortgage interest rates. So let's jump into this article real quick, and then I'll bring you guys over to that chart as well. So from CNBC, it says Fed minutes point to more rate hikes that go further than the market anticipates. The Federal Reserve officials earlier this month stressed the need to raise interest rates quickly and possibly more than markets anticipate to tackle, basically to combat inflation. Everybody's feeling inflation right now, obviously. We have been feeling inflation, so this is the headwinds that the Fed is up against. Not only do policymakers see the need to increase benchmark borrowing rates by 50 points, but they also said similar hikes likely would be necessary at the next several meetings. They further noted that the policy may have to move past a neutral stance in which it neither is supportive nor restrictive of growth, an important consideration for central bankers that could echo through the economy. Most participants judged that 50 basis points increases in the target range would be appropriate at the next couple of meetings per the minutes. And the layout of plans starting in June to reduce the central bank's $9 trillion balance sheet, consisting mostly of treasuries and mortgage-backed securities. This was the biggest rate increase in 22 years and came as the Fed is trying to pull down inflation running at a 40-year high. Now, I've said this on other videos as well. If we were in this extremely healthy economy, healthy real estate market, healthy stock market, and everything else, why would we have the government buying billions and billions and billions worth of mortgage-backed securities? Why are they pumping so much money into the system? And ultimately, it's backfiring because we are all feeling the effects of inflation, and unfortunately, this is what we're left with. We're left with really high prices on things, and now the Fed is up against the wall. They're really the only tool in their tool bag per Powell is to raise the Fed rates. This way it kind of slows down the economy, and maybe we can get back to an equilibrium. But as George Gaiman says all the time, they're probably just going to increase rates until something breaks, and ultimately that's probably going to be a recession where we could see mass layoffs and everything else, unfortunately. Now let's jump over to the you guys can access this as well. You can literally type in Fed rates FRED, F-R-E-D, or mortgage rates FRED, and you guys can come up with this chart. But what I did was I added a line item. So not only do we have the Fed rate here, which is in blue, we also have the 30-year fixed mortgage rates, which is in red. So right now, as you can see, we have this tiny uptick over here, and our 30-year fixed rates right now per April are per May 5.25%. So right now we can see the Fed rate is extremely low, but mortgage rates just jumped pretty high pretty quickly as well. So this is a sign, in my professional opinion, being a real estate broker for the last since 2006, real estate agents since 2003. I think that we're probably going to see more hikes in the 30-year fixed rate. But let's go ahead and take a look back in, say, 2005, 2006. So the Fed kept raising rates, and then eventually we came into a recession. Now, if you see right here, the gray lines across the board, you can see the gray lines going up and down. That means a recession. Okay, so back 06, 07, this is when the real estate market started to turn. This is the peak of the real estate market. And we can see where the Fed rates were, and we can see the 30-year fixed rate was about 6.25%. But if we look at the spread in between the two, the mortgage rates were not that much higher above the Fed rate. The Fed rate was 5.25, and mortgage rates were 6.25. And now if we come over here, like we said, we're at 5.25%, and the Fed rate is under 1%. So is this an indication that mortgage rates go even higher? Possibly. But let's go ahead and slide back into the 80s and see where, if you look in the 80s, the peak, October of 1981, the 30-year fixed mortgage was 18.39%. Now, do I think we're going to get back to those kind of rates? Probably not. But who the hell knows? But I can tell you, real estate, the price of real estate was not nearly as high as it was back in the 80s relative to wages and wage growth and everything else. And I think that if rates go even a little bit higher, it's really going to be devastating for the real estate market. Now, a couple things to touch on before I depart from you guys. The current rates, we are seeing a slowdown in the real estate market. The Northeast is still seeing an uptick over there, but everywhere else is starting to slow down, starting to flatten out, and some areas are actually starting to go down in value. Now, the mortgage interest rates have upticked. It's actually hurting new construction as well. And it's pricing people out of the market. People were relying on, say, 2.75, 3.25% for a 30-year fix. And now we're at, 5.5%. And unfortunately, that could add $300, $400, $500 more per month in interest to people's payments. So it's pricing people out. And then for others, I think that other people are looking at kind of what I'm looking at is, if rates do go up, then people maybe are right now in a frenzy, like, mortgage interest rates might go even higher. They might go to 6, 7, 8%, maybe even higher, who knows. And if they do, they feel probably that they will definitely be priced out of buying a home. And I think that if you're in that boat, then you might want to kind of second guess some things as well, because, for everything that goes up, things come down. And also, I think if we go into a whole different real estate market and you have people, I think it's like 35% of people are free and clear on real estate. And I think that there's going to be seller financing opportunities out there as well, especially if mortgage interest rates just skyrocket to the moon. Anyway, let me know your thoughts. Where do you guys think the 30-year fixed mortgage rates are going to be, say, in July, August? Let me know your thoughts below. And if you got any value out of this, please hit that little share button and share it to a friend, maybe just one friend that could utilize this information. Thanks a lot for being here.